Have you ever heard the term ETF and immediately felt overwhelmed? Like it was something only Wall Street pros or finance nerds needed to understand? Let me tell you something. ETFs are actually one of the simplest, smartest, and most beginner-friendly investing tools available today. And in this video, I'm going to break down exactly what an ETF is, why you should care, and how to invest in one even if you're starting with $100 or less. Let's begin with the basics. ETF stands for Exchange Traded Fund. Sounds technical, but here's the easiest way to understand it. Imagine going to a buffet. You don't just order one dish. You grab a plate and try a little bit of everything. Rice, chicken, salad, dessert. That's what an ETF is. Instead of buying a single stock like Apple or Google, you're buying a basket that includes many companies at once. So when you invest in one share of an ETF, you're actually getting exposure to dozens, sometimes hundreds or even thousands of companies. That's powerful because it gives you instant diversification. Think of it as spreading your eggs across many baskets. If one stock in the ETF goes down, the others may balance it out. That's way safer than putting all your money into one company and hoping it performs well. Now here's what makes ETFs even more exciting for beginners. They trade just like regular stocks. You can buy or sell an ETF anytime during the trading day. Unlike mutual funds, which settle only once per day at market close, ETFs have real-time pricing. That means more flexibility, more transparency, and more control for you as an investor. When it comes to ETFs, there's truly something for everyone. The variety available is one of their greatest strengths, allowing you to build a portfolio tailored precisely to your goals. Let's break down the main categories in detail. 1. Stock ETFs. These ETFs invest exclusively in stocks, and they're by far the most popular. Stock ETFs often track specific indexes. For example, VOO, Vanguard S&P 500 ETF, follows the top 500 US companies like Apple, Google, and Microsoft. Stock ETFs are ideal if you're looking for growth and want your investment to appreciate over time. However, they can fluctuate more depending on market conditions, making them suitable for investors with a long-term outlook. 2. Bond ETFs. Bond ETFs invest in a basket of bonds, which are essentially loans you make to corporations or governments in exchange for regular interest payments. These ETFs provide steady income and usually experience lower volatility compared to stock ETFs. For example, BND, Vanguard Total Bond Market ETF, holds thousands of US government and corporate bonds, providing stability and regular income, ideal for balancing out your investment portfolio, especially during economic downturns. 3. Dividend ETFs. Dividend ETFs focus specifically on stocks that pay dividends. These are cash payments made regularly to shareholders. If you're aiming for passive income, these ETFs are a great choice. A perfect example is SCHD, Schwab US Dividend Equity ETF, which includes financially strong dividend-paying companies. Over time, dividend ETFs can generate a steady stream of income, which you can reinvest to compound your returns. 4. Sector ETFs. Sector ETFs invest in companies within a specific industry, like technology, healthcare, finance, or energy. For example, the XLK, Technology Select Sector SPDR Fund, holds companies like Apple, Nvidia, and Adobe, focusing exclusively on the tech sector. Sector ETFs allow you to invest in specific market trends or industries you believe will outperform, but be aware. They come with higher risk since you're concentrated in one particular market segment. 5. Commodity ETFs. Commodity ETFs invest in physical goods like gold, silver, oil, or agriculture products. For example, GLD, SPDR Gold Shares ETF, tracks the price of gold, allowing you to invest in precious metals without having to physically store them. Commodity ETFs are often used as a hedge against inflation or as a way to diversify your portfolio beyond stocks and bonds. 6. International ETFs. International ETFs provide exposure to companies and markets outside your home country. This helps you diversify globally, protecting your portfolio if your home market slows down. For instance, VEU, Vanguard FTSE All World ex-US ETF, gives you broad exposure to major global markets, excluding the United States, including companies in Europe, Asia, and emerging markets. These ETFs can offer great growth potential, but may also carry additional risks due to currency fluctuations and geopolitical factors. 7. Real estate ETFs, REIT ETFs. Real Estate Investment Trust, REIT ETFs, invest in real estate companies or property holdings. They offer exposure to real estate markets without requiring large upfront investments or active management. A great example is VNQ, Vanguard Real Estate ETF, which invests in hundreds of commercial and residential property companies, providing steady dividend income and long-term appreciation potential. 8. ESG ETFs, Environmental, Social, and Governance. ESG ETFs invest in companies that prioritize environmental sustainability, social responsibility, and good governance practices. Investors who prefer ethical or socially responsible investing often choose these funds. For instance, ESGU, iShares ESG Aware, MSCI USA ETF, includes U.S. companies that meet certain sustainability and ethical standards, letting you invest according to your values without sacrificing returns. Now here's where most beginner videos fall short. They don't explain the why. Why should a beginner choose ETFs over, let's say, picking individual stocks or crypto? Here's the truth. ETFs are designed to make investing easier. With one purchase, you're spreading your money across multiple assets. That lowers your risk. You don't need to study earnings reports, track stock charts, or spend hours on Reddit. ETFs let you invest without obsessing. Another huge plus, low fees. Most ETFs are passively managed, meaning they just follow an index. That keeps management costs extremely low, sometimes as little as 0.03% per year. Mutual funds, on the other hand, often charge over 1% annually, and those fees eat away at your returns over time. Let's break it down with numbers. If you invest $10,000 into a mutual fund with a 1% fee, you'll pay about $100 per year in fees. Over 20 years, that could cost you thousands in lost gains. With an ETF charging 0.03%, you'd pay just $3 per year. That's a massive difference. Now, here's the million-dollar question. Which ETFs should you actually invest in as a beginner in 2025? Choosing the right ETF can feel overwhelming at first, so let's simplify this with specific examples, clear reasoning, and actionable guidance. First, always start with ETFs that give you broad exposure. These are ETFs that cover hundreds or thousands of companies, dramatically reducing your risk. Here are the best ETFs for beginner investors in 2025, carefully selected based on stability, diversification, performance history, and low costs. 1. VTI, Vanguard Total Stock Market ETF. This ETF is perfect if you want simplicity and maximum diversification. VTI includes every publicly traded company in the US, over 4,000 stocks in one ETF. With companies ranging from established giants like Apple, Amazon, and Microsoft to smaller high-growth firms, VTI provides broad, balanced growth. Historically, it delivers steady returns, averaging around 8–10% annually over long periods. It's a true set-it-and-forget-it choice for any beginner. 2. VOO, Vanguard S&P 500 ETF. If you prefer to invest specifically in America's largest and most stable companies, VOO is your best friend. This ETF tracks the S&P 500 index, which includes the 500 largest U.S. corporations, like Google, Tesla, Johnson & Johnson, and Coca-Cola. Warren Buffett himself recommends this ETF for beginner investors due to its proven long-term track record, low fees, and stability. It's historically delivered consistent growth and is ideal for those seeking steady, reliable returns without daily stress. 3. SCHD, Schwab U.S. Dividend Equity ETF. If passive income through dividends interests you, SCHD should be your go-to ETF. This fund carefully selects companies that not only pay consistent dividends, but also have a strong record of increasing them annually. Examples include Coca-Cola, Home Depot, and Pfizer. This ETF can generate steady cash flow, and you can reinvest dividends automatically, creating a powerful compounding effect that accelerates your wealth-building journey over time. 4. QQQ, Invesco Nasdaq 100 ETF. For those looking for more growth and are comfortable with higher risk, QQQ could be ideal. It tracks the Nasdaq 100 index, representing America's 100 largest non-financial companies, particularly technology giants like Apple, Microsoft, Nvidia, and Amazon. Historically, QQQ has delivered substantial growth, significantly outperforming broader markets, though it can be more volatile. It's ideal if you have a higher risk tolerance and a long-term investment horizon, 5-10+ years. 5. VT, Vanguard Total World Stock ETF. Finally, if you want a truly global approach to diversification, VT is the ultimate all-in-one ETF. It invests in over 9,000 companies globally, including stocks from developed economies, US, Europe, Japan, and emerging markets, China, India, Brazil. It's ideal for investors who want maximum geographical diversification and exposure to growth opportunities outside the US. This ETF reduces your dependence on any single economy or region, providing broader protection and global growth potential. But how do you actually pick among these ETFs? A simple approach is to mix and match based on your specific goals. If your primary focus is long-term, worry-free investing, consider something like 60% in VTI, steady US market exposure, 20% in SCHD, consistent dividends and passive income, 20% in VT, global diversification and international growth. Alternatively, if you're younger, comfortable with risk, and aiming for maximum growth potential, you might try 40% in QQQ, aggressive tech-focused growth, 30% in VOO, stability of large US companies, 30% in VT, global diversification. Each of these ETFs can be purchased through beginner-friendly platforms like Robinhood, Fidelity, or M1 Finance, all offering fractional shares, meaning you can start investing in ETFs with as little as $5 or $10. Remember, the key to success isn't just picking the perfect ETF. It's about consistency, staying disciplined, and sticking with your investment plan over the long term. Keep adding money regularly, no matter what the market does, and let compounding turn your small contributions into substantial wealth. Now let's talk about how to actually invest in an ETF. This is the part where most beginners get stuck. Not because it's hard, but because no one explains it step by step in a way that actually feels doable. So let's walk through it like we're doing it together. First, you need to choose a brokerage platform. This is where your investments will live. In 2025, some of the best beginner-friendly platforms are Fidelity, Robinhood, and M1 Finance. Fidelity is great for long-term investors who want access to Roth IRAs and excellent support. Robinhood is super simple, easy to use, and has zero commissions, making it great for total beginners. And M1 Finance is perfect if you want to automate everything. It lets you build custom ETF portfolios and invest your money on a schedule. All of these platforms offer free signups, fractional shares, and $0 minimums, so you can get started with even $5 or $10. Once you've chosen your platform, you'll need to open the right kind of account. Most people start with a standard brokerage account, but if you're in the US and you're investing for the long term, especially retirement, you should strongly consider opening a Roth IRA. With a Roth IRA, your investments grow tax-free, and you can withdraw them in retirement without paying any taxes. Even if you're only contributing $50 a month, starting with a Roth IRA is one of the smartest financial moves you can make. After setting up your account, it's time to choose your ETF. You do this by typing in the ETF symbol. For example, VTI gives you exposure to the entire US stock market. VOO tracks the S&P 500. SCHD focuses on dividend stocks. QQQ gives you tech growth, and VT offers worldwide diversification. Once you find the ETF, click on it and you'll see a bunch of information. Its current price, past performance, and what companies it includes. Now comes the fun part, deciding how much to invest. Don't let the share price scare you. Thanks to fractional shares, you don't need $300 or $400 to invest in an ETF anymore. You can literally start with $10. So let's say you have $100. You could invest $50 in VTI for broad U.S. market exposure, $30 in SCHD for dividend income, and $20 in VT for global diversification. Once you've decided, you place your order. Choose buy, enter the dollar amount, and place a market order to execute at the current price. That's the simplest way for beginners. And just like that, you're now an investor. But here's the real magic: automation. Most platforms let you automate your investing. That means you can set it up so every payday, $25 or $50 automatically gets invested in the ETFs you've chosen. This removes emotion, helps you stay consistent, and ensures you're buying more shares when prices dip. A strategy called dollar cost averaging. It's one of the most powerful habits you can build. Over time, this simple system can turn your spare change into serious long-term wealth. And remember to reinvest dividends, track your performance with free tools, and most importantly, stay consistent. Even if you're starting small, every investment moves you closer to financial freedom. Now here's something that almost nobody talks about in ETF videos: the psychological side of investing. As a beginner, it's easy to get impatient. You put in $100 and expect to see results in weeks. But investing isn't a sprint, it's a long-term game. ETFs are built for that. Their strength isn't in overnight gains, it's in compounding over years and decades. And that's why you need to stick with it. Keep adding, keep investing, even during dips. In fact, when markets are down, that's when ETFs go on sale. That's the best time to buy. History shows that the market has always recovered and grown over the long term. You don't need to be perfect. You just need to be consistent. And if you're worried about taxes or fees, just remember, most ETF brokers offer free trading. And if you use a Roth IRA or similar tax-advantaged account, you can build wealth without ever paying taxes on your gains. That's one of the greatest gifts in the investing world. Use it. Let's recap everything we've learned. An ETF is a basket of investments you can buy with one click. It gives you instant diversification, low fees, and flexibility. It's better than mutual funds for most beginners due to lower costs and real-time trading. You can start investing with $5, $10, or $100 using fractional shares. Stick with ETFs long-term and automate your contributions. That's it. You now know more than 90% of first-time investors. If you found this video helpful, please like, subscribe, and comment below with the ETF you plan to invest in first. And don't forget, this is episode 2 of our Foundations of Investing series. In episode 3, we'll teach you how to build a full ETF portfolio based on your goals, risk level, and timeline. Let's build wealth together, one smart, simple decision at a time.